Hi there, welcome to the Option Pit webinar of the month. I am Mark Sebastian, the founder of Option Pit. This is Ride the Wheel and Hedge. So we're going to talk about riding the option wheel, and we're going to talk about some ways to hedge a portfolio, and it should be hopefully a good webinar. All right, and that is me. That is me a couple years ago. I look even more handsome now. I've been taking Propecia, so I probably will have a little more hair. I have been working out, so I'm probably far more muscular. And, well, you can't fix that golden smile, folks. So, there you have it, folks. So I was a floor trader for 10 years, if you didn't know, and then now, since then, I've started Option Pit. Option Pit is an education and consulting company. We work with traders at the professional and retail level to show them how to trade like a professional. We work with hedge funds, showing them, helping them implement hedging and and other types of option strategies. Work with individuals, teaching them the approach to trade professional that we learned from the people who taught us. And on top of that, we run a small hedge fund. Myself and Andrew, who's one of my partners. Actually, all the partners are involved in the fund. It's called Carmen Line Capital. It's for accredited investors only. If you got questions and you're accredited, you may email me, mark@optionpit.com. Otherwise, just be aware that I think the big thing that differentiates us, and this is why I bring that up, not because I'm looking for money, it's because we actually trade here. And we are the traders who teach. We are not an education company. So we're going to talk a little bit about options and insurance. We're going to talk about covered calls, cash secured puts, the wheel. I'm going to talk about Crisis Alpha and VIX ETP hedges. So if I were to use options in one word, what word would I use? And I think many of you should know this. I would use the term insurance. Insurance. Options are an insurance contract. Calls, which are the right to buy stock, insure against the loss of dollars in a long position. Puts insure against the loss of dollars in a short position. So I can buy puts instead of shorting the stock. Thus, if I short something like Tesla, and Tesla rallies on some silly stuff involving, car deposits, I'll be okay. But the thing to remember is, do insurance policies last forever? I mean, whole life does, but that costs an arm and a leg. And term life doesn't. Car insurance doesn't. If I cancel my policy and switch, do I get all of my money back? No. No. Especially in a whole life policy, it decays. It has surrender fees, all sorts of different things like that. So if I cancel a policy, I don't get all my money back. So the thing to remember is options, like all insurance, decay in value over time. We use that as theta. What I think is a little different about options is that, the rate of decay is a little different, but not that different from most insurance contracts, the way it's amortized. So this is kind of the decay in a long call. And the red line represents kind of movement on August 15th. The yellow line is the 22nd. These are all a week at a time. And what do you notice as weeks pass? The spread between each of these lines gets wider. All right, the purple line representing September expiration. All right, and that kind of shows you from a visualization standpoint how this option contract loses value over time. It loses more and more value with this at-the-money option as time passes. All right. This is a chart of at-the-money premium selling. And what I want you to notice is at 30 days, it starts to really pick up. And at 8 days, it picks up even more. However, is that the way all decay works? Is that the way all decay works? No, it is not. All right. The further away I move from at the money, the more linear the decay is. The further away I move from at the money, the more linear decay is. So, believe it or not, with some out of the money selling strategies, you can make more money selling stuff way out of the money longer term than near term. It surprises people. All right, so there are several ways to use stock and options together. A lot of people use stock. They go, oh, look at me, I own Apple. I've got Apple in my 401k, I've got Apple. Great. Now, I would go out and say you should almost never own Apple Premium, or you should never own stock itself, one of the things I say. But if you're going to own it, the way to do it is to at least produce a covered call against the stock position, and or have a do some sort of short put in place of owning stock. I'm going to talk about it. And then the way I'd like to see it traded is called the wheel. And we'll go through this. So let's start with making a covered call. All right, and this is Facebook, or the Facebook as it was originally called. And what we have here is a 10 lot, 1,000 shares of Facebook stock. All right, Facebook's trading 102.38. Now, when we sell a call, we collect time premium. All right, and in this case, we can sell a call at $2, and you can actually see again. This is a March call. You've got the Feb. On Feb 11th, you can see how that decay moves, and on March 17th, you can see how the decay then moves. This is a covered call. Graphs are from LiveVolX, if you are wondering. Combined, all right, so if I combine selling the call and owning the stock, I get a trade that looks like this. And that is wrong. Notice our break even is now below 138. Fix that. All right, but in exchange, I've got capped out profit. So the net of the trade is you've collected premium on the trade, which lowers our cost basis, lowers my cost basis on the stock. I love Facebook stock. All right. You limited the upside because if the stock moves above the call strike price, our stock can be called away. Our break even is now 103, 138. But the most we can make on our combo is up to 107 minus our risk, so about $5. Because I sold the 105 call. Right, 105 plus 2 is 107 minus 102.38. So it's important. All right, and so this is a key. So the lowdown, I don't know why it's the strike price is 105, option price is $2. Sorry about the typos, folks. You know, I'm a trader, not a professional dictation machine, unfortunately. So what is the yield of the trade on the takeout? Our stock price is 102.38. We have a stock price of 105. The option price is $2. So our total return is the strike plus the option price minus the stock price over the stock price, or $4.62, which turns into 4.5%. All right. If I'm going to do covered calls or short puts on full margin, I want to make at least 1%. All right, so a covered call can be done with an existing stock position. We see this all the time. And simply pick a call that you want to sell against the stock that you might own. It can also be done as a package in a trade called a buy right. We used to trade these all the time. The Monday after expiration, we used to call buy right Monday, because we would get hundreds of people coming in to just dump to do these buy right trades. All right. And the trader buys stock, sells a call, and does it as a package. And a buy right can then become a covered call trade if you don't get your stock called away. So let's talk about the management mechanics. All right, if you do not get the stock called away, buy the call back and sell another call. If you can buy the call back for really less than a dime, but at least a nickel, always buy it back. All right, and then sell another expiration. You will make more money doing that. All right, and you know, let me just quickly show you this. And why you want to do this. All right, and we can look at IBM values or something like that to kind of figure this out. So, well, let's pick one that didn't have earnings. Let's do Apple. All right, so what I want to do is we'll just look at this week, and we'll just look at, so here's Monday. And I want you to look at kind of some of these out-of-the-money options. So Apple was trading 107 at the close. And my 113 calls, I could buy back for less than 10 cents. All right? And let's say I'm just going to sell the next week out. And I'm going to do the 113s again. And yes, I'm aware. So the 113s here are 90 cents. All right, now, here we are yesterday, almost the exact same stock price, right? About 30 cents different. And what I want you to notice is my 113 calls, they lost 6 cents. What about the ones in the next week out? How much did those calls lose? They lost 30 cents. So by squeezing 7 cents, you know, and we'll account for the delta, we'll say it was, 25 cents. So by squeezing those 7 cents out of my Apple trade out of my Apple covered calls, how much did I cost myself in my next week's covered call? How much did I cost myself? Yeah, you know, I made 7. Yeah, it cost about 20 cents. I mean, I'm trying to imagine a scenario where saving the commission cost is worth it. I mean, you would have to be trading a 1-lot covered call against 100 shares, and you would have to have commissions north of $15 a contract. You know, so let's just say that you save, after commission, you save 10 cents a week on a single 1-lot. All right, that's $10 a week. So that's 10 times 52. 10 times 52. You save $520. All right, well, if you're only trying to make 50 cents a week, how much you actually, you know, in this case, or let's say, you know, let's go crazy and say 60 cents a week. 60 times 100 times 52. So you're only trying to make 3,000. No, I was just picking an option that was kind of worthless to show you that where the value. So if I can make an extra $520 on top of my 31.20, I'm increasing my yield by 17%. Just by not being a jerk and waiting for the underlying to and trying to save myself $8 a commission. You shoot yourself in the foot when you do that. All right, now let's talk about if the stock does get called away. One of the common mistakes I see people make is they're in a stock and the stock runs and they get the stock called away. And they go, oh, I want that stock. Oh, I love that stock. It's going up. More often than not, the stock turns around right after the trader buys it and they're wishing they wouldn't have traded it. So if the stock gets called away, wait a day or two. All right, allow the stock to get called away or cover the call and sell the stock. Or do something more in the money. Don't do whatever your normal covered call routine is. So wait, then enter. All right, in a perfect world, the underlying would creep higher every month but would not skyrocket. The trader would be able to consistently sell calls at higher and higher strike prices, building yield. The stock is never called away until the very top, and the stock pays a dividend. That's the perfect covered call. All right, and that's kind of been Microsoft and over the last year. You know, IBM used to be the covered call king, and then it turned into hot garbage. Yeah, Coke is another one. So there are lots of good covered call stocks. What you'll find is that generally speaking, lower volatility stocks are better for covered calls and short puts than high vol stocks. So a short put is kind of like selling a slightly in the money covered call every month. The trader never really owns the stock because his calls are in the money. And if there is a dividend, the stock will get called away and the trader keeps the premium. So he never really owns the stock. That is a short put. In FASA book. Mufasa book from the Lion King. So now let's look at this. All right, a trader sells the March par put at $4. If the stock settles above $4, the trader, or me, keeps all the premium. All right, I keep some of the premium if the stock settles less than $4 below $100, and the break even is $96. Not so bad. Great way to enter stocks. All right, think of selling puts as kind of like buying the really attractive girl a drink at the bar. All right, it's your way of getting in. So, you know, it's a good way to kind of make something happen in a stock that maybe is a little more expensive than you'd like. So a short put should be sold in a stock that you want to own. The strike selection and premium selected should be at a level that the trader would be willing to take delivery, even if it's less than that net price. All right, it is important to keep track of the total net premium collected on each put sale. This is the true underlying price if stock delivery is taken. And what do I mean by that? So let's look at this. I have 6 sales in Facebook. In September, I collected $3, and these are all fake. Let me be clear. In September, I collected $3. In October, I collected $2.50. November, $2.50. December, $2.50. February, $3.50. All right. If I took delivery on my March, let's just say March, par sale at $4, what is my net ownership price? $81. That's great. That is great if the underlying is 90 or 95. It stinks if the underlying is 50. Really stinks. So the perfect short put. In a perfect world, the underlying stock would creep lower or sit every month but would not tank. The trader would be able to consistently sell puts at lower and lower strike prices, building yield. The stock is never delivered except at the absolute bottom, and the stock pays no dividend or the div is reduced. So now that you've seen covered calls and short puts, let's discuss the wheel. Now, I said you should never buy stocks. That's true. That doesn't mean you should never take delivery on stocks. There's a difference. All right. A wheel is a combo of short puts in order to take delivery on a stock, then a sale of covered calls to get out of the stock, and then hopefully you try and get a dividend. So the mechanics. So I sell a put in Microsoft. I can do it weekly or monthly. All right. Weekly is going to be your more active way of selling puts in Microsoft. It's more flexible on strike selection. It's more dynamic. All right. However, it takes a little more nuance. Monthly is much easier. You collect a larger bulk premium, but less overall. All right. So you collect, if you sell one put a month, you collect a little less, but it's far more stable and easy. It's way more passive. If you do weeklies, you will collect more, but you will have a lot more volatility in when you take in kind of where your strikes are set relative to the underlying. So if the trader takes delivery, the trader then sells calls against the stock that they just took delivery on until the stock gets called away. Hopefully there's a dividend, and the trader can collect this while he or she sells covered calls. The trader should ensure that he or she does not get called away at a loss. All right? If you can't sell a call at a level where if you get called away you'll still win, then you should do one of two things. All right? You should either dump the stock, or you should not sell a call. One of the two. So now the keys to this wheel strategy, and it's great for stocks that you want to own. Keep track of all premium collected. Make sure one knows the net ownership price. So you have to know what your real cost of entry is. And you hopefully take delivery at a low in the stock. And when a stock is below the strike, it might make sense to buy the stock. All right, that's what you want. Do not sell call levels where you'll lose. And now, here's one thing you can do. You can sell call spreads. This is one little nuance I'll show you. So there's my Apple stock. Now, let's say Apple, Apple's cheap. Let me, this contract I don't have. There you go. So what if I sell, what if my net ownership price is 110? All right, well, I can either sell the 110 call, or what if I'm afraid of Apple taking off? What if I sold the 110 call and bought the 115 call against it? I sold the call spread against my stock. Well, let's take a look. You can see what this is going to do. At expiration. So you lose your stock for a little bit, and then you get it back. It's a good way to enter the trade. And hopefully you sell at the top. All right, now let's talk about my BXY and put wheel. This is for a retirement account. All right. Now, do we all know what PUT is? PUT is an index the SIBO's pushing really hard right now. And what it does is it sells an at-the-money SPX put, the first put out of the money every month. And it outperforms the S&P and has a lower volatility. All right. BXY sells a call that is 2% out of the money every month. And it actually outperforms the SPX as well and does, in fact, lose some, drop some volatility. So the concept of this wheel we're going to apply to SPY in a retirement account. Anybody own SPY or an index fund or something like that in their IRA? Great. Of course you do. So what you're going to do is you're going to sell SPY at the first strike out of the money every month until you take delivery on SPY. Then, when you take delivery, you're going to switch to selling calls that are 2% out of the money. Just like a wheel. And let me tell you, so here's PUT. Here's BXY. What are the big differences between PUT and BXY? PUT collects a lot more premium. BXY has a lot more what? Upside capture. Makes a big difference. So if you run PUT and BXY, we did this as a study, and we ran them against each other. And we were trading PUT index. Then when we took delivery, we switched to BXY. And I'll tell you, when you trade at BXY, month in and out until you get that rally of 2%, you absolutely crush the S&P 500. So this little SPY system, they're actually, you don't buy PUT. There is a PUT fund by Wisdom Tree. It's an ETF. So the way you recreate PUT is by selling an at-the-money put every month in SPX. But what I want to do is in SPY, in a retirement account, I want to sell the first put out of the money. And then when I take delivery, I'm going to flip to being long stock and selling a call 2% out of the money. Look at this. So this is a very simple strategy, and you don't have to be smart to do this. So how do you participate in this? You have to actively trade it, although I'm thinking about starting up a fund that does this. All right. So now, my wheel combo for that IRA account is going to do close to 10%, and it's going to have a standard deviation about 75% of the S&P 500 total return. You're going to kick the crud. And this was a 25-year study, folks. This was not a small study. I went back to 89. And now you're saying, Mark, I love your idea, but I'm also terrified of the stock market because asset prices are a bubble. I own gold. Rich, ask me at the end and I will. Asset prices are bubble. I own gold. I wear a tinfoil hat. The world's coming to an end. All right, well, I'm going to give you my strategy. All right, so on its own, my system works. Now, look at VIX VXV. When VIX is more than 1 point over VXV for 5 days, cover the short put. Get back in when it recrosses below 0 for more than 3 days. This will avoid catastrophic loss and will help you basically produce a net win. And you can see it doesn't happen that often. All you're doing is missing some of these big dips. You know, if you look at VIX over VXV, this will come out in a minute. You can see that you essentially get back into stocks on March 15th. How's the S&P done since March 15th, guys? You get your all clear at what amounts to the 200-day moving average. Not so bad, eh? Now, you're saying, Mark, that's too much for me? And here's 2008. This strategy gets you out in September and gets you back in April. You miss the drop from 1,200 and you get back in below, in between Yeah, you get back in just above 800. There's 400 points that you get back. How's that feel? All right, so now let's talk briefly about Crisis Alpha. It's an alternative going to cash. All right, and what you do is you have to use some sort of long vol product to step in and hedge. And my friends Mike and Matt Thompson have the KZT vol index that you can get on Bloomberg. And they actually run a mutual fund that runs this vol index with the total return. So what this index does is when it goes long, it basically goes long VIX futures. All right. And so when KZT vol says buy, in that its dollar figure starts to move, buy VXX against a portfolio of stocks using 25 to 50% of the margin. It's run by my friends Mike and Matt Thompson. They run an overlay that recreates it at Typhon Capital Management. Not an endorsement. I mean, they're my friends. But I really like this vol index, and so it's one that I follow. You can see kind of where it steps in as well. Similar to that VIX VXB strategy. All right, so now let me I'll answer questions as soon as I get done with this. Special offer. So on Saturday, May 7th, we're doing options for long-term investing and hedging. If you learned something here, imagine what you're going to learn in this 4-hour intensive. All right, you're going to learn to replace stock investment with options altogether. We're going to teach you how to improve capital efficiency. You're going to learn to produce better and more income, and you're going to learn to hedge like a professional desk trader. Normally it would be $395. It's just $167. Use code 25_off. It is case sensitive to take an extra 25 bucks off. All right, through Saturday, so just $142. Now, if you are an Option Pit subscriber, Option Pit Live, Gold, Platinum, Professional, Silver, this is free, so don't buy it. All right, and if you're doing the math, a subscription to Option Pit Live is $125 a month and includes our chat room and the strategy letter, or you can buy this course for 142 bucks. And we do one of these just about every month. We do 10 a year. So what is 10 times 167? 1670. What is 125 times 12? 1500. It is cheaper to have a subscription than to buy these courses a la carte. That said, the course a la carte, super worth it as well. All right. Go to optionpit.com/long-term to register. So you just go to optionpit.com. And it's right there. Now, in addition, I will have Riding the Wheel right here for you to rewatch tomorrow. All right, now, what questions do we have? And I will provide a replay. Can I explain VIX VXV? VIX is the 30-day vol index. VXV is a 92-day vol index. And so when VIX is higher than VXV, that shows that the market is under some real stress. Yes, that is, it tells you that downside, immediate fear is greater than long-term fear. That's really what that means. And let me show you how I might set up the wheel, just real briefly in SPY. So in SPY, I would go to May, and I'd look at the 208. We settled 208.97. So what is the first put in May? What is the first put in May that's kind of right out of the money? Well, we have the 208.5 put. So I would sell the 208.5 put. And then if I take delivery, I would then sell a call that is 2% out of the money. Let's say I took delivery at 208. Well, what is 2% out of the money of 208? $212. So I would sell the 212.16. I would sell in June. I would sell the 213. Really, would you hedge a long-term portfolio with today's market? I mean, I'm not overly concerned. That's why I really like the idea of crisis alpha, as opposed to hedging, as opposed to kind of hedging. And the type of hedging I usually do is going to be in something like VIX, as opposed to the SPY itself. And that's the type of stuff we're going to teach you. We're going to teach you how to hedge with VIX. We're going to teach you how to hedge using things like BXX, and then we're also going to teach you some potential ways to produce income and be hedged at the same time using SPY and SPX in this awesome course that we're going to cover. Now, if you've got questions, you can email me, mark@optionpit.com. You can call me 888-TRADE-01. That's not tirade, that's trade. All right, any other questions? You guys learn some things? All right, you go to optionpit.com/long-term, and then you buy it, and let me show you, here's how to use that code. See, it's already 167.25_OFF. It's all caps, then click apply. So I saved myself $25, although I'm not going to be buying the course since I teach it. All right. Okay, folks. I will have this posted. You'll get a replay tomorrow. Have a great evening. I really want to thank all of you. You guys are great, and appreciate your patience. I'm a monthly subscriber. Can I be in the course for free? Yes, you can. That's the beauty of being a monthly subscriber. If you're on Option Pit Live, it's free. Have a great day, everybody.